The world's attention is riveted on the unfolding drama in the stock markets. Investors are holding their breath, watching the escalating trade war between the world's two largest economies wreak havoc on exchanges. The American stock market is going through tough times, with stocks plummeting for the second day in a row. The Dow Jones Industrial Average, as if brought down, lost 1,000 points after yesterday's collapse of almost 1,700 points. The reason for this is the escalation of the trade confrontation initiated by President Trump. The markets are in turmoil, and futures on American stocks are showing a sharp decline. Beijing has imposed retaliatory tariffs of 34% on imports from the United States, the most serious escalation in the trade war between the two countries since April 4th. Events are developing rapidly, fundamentally changing the course of the global economy. Tariffs announced by the United States on April 2nd led to a one-day collapse on Wall Street of $3.1 trillion. Beijing's response triggered a second wave of panic in the U.S. markets. The growing economic confrontation between the two global giants, which had been brewing for years, has escalated into an open trade war in recent days. Against the backdrop of another fall in American stocks, the question of the further trajectory of this escalation sounds all the more alarming. China has long made no secret of its dissatisfaction with the unilateral actions of the United States and the introduction of new duties. A decisive step in this conflict was the introduction by the Trump administration on April 2nd of new tariffs covering almost all sectors. Particular outrage was caused by additional duties, reaching 50%, aimed directly against Chinese goods. In response, Beijing demonstrated firmness, announcing through the Ministry of Commerce the introduction of mere 34% duties on imports from the United States, guided by the principle of reciprocity. This news triggered a new wave of panic in the American stock market, dubbed by analysts as the second bottom. Leading publications such as CNN and The Washington Post came out with headlines stating another collapse of American stocks. Tension is again felt on Wall Street. By the end of 2024, trade between China and the United States reached an impressive $660 billion. At the same time, the lion's share, about $530 billion, falls on Chinese exports to the United States, while American goods heading to China amount to only $130 billion. This imbalance has long been the subject of criticism from Washington, pointing to a significant trade deficit. The American authorities expressed dissatisfaction with the fact that the Chinese market is literally flooded with various products, while exports from the United States cannot be compared with these volumes. In an attempt to change the situation, at least partially, high tariffs were introduced. However, retaliatory measures from China have created new obstacles for American goods. Now, products from the United States intended for the Chinese market in key sectors such as agriculture, automotive, electronics, and mechanical engineering are subject to a hefty 34% duty. Experts have repeatedly warned about the possible consequences of such developments for the American economy. The United States exports billions of dollars worth of agricultural products to China, especially soybeans, meat products, and corn. The introduction of 34% duties on imports from the United States may push Chinese consumers to look for alternative suppliers, which is fraught with serious losses for farmers in the Midwest. The experience of 2018 to 2019, when American-Chinese trade disputes already inflicted a tangible blow on agriculture, shows that even government subsidies are not always able to compensate for the loss of sales markets. The current situation, apparently, promises to be even more large-scale and painful. The automotive industry is also under attack. Giants such as General Motors, Ford, and Tesla either export their products to China or depend on supplies of components from this country. The retaliatory Chinese duties call into question the competitiveness of American cars in the Chinese market, creating prerequisites for further construction of trade barriers. Rising prices, disruptions in the supply of raw materials and components, and narrowing export opportunities can all lead to a reduction in the profits of American automakers. It is likely that companies will be forced to resort to unpopular measures, such as reducing production volumes, laying off personnel, or raising prices for consumers. In recent weeks, Tesla shares have shown a downward trend, which was due to the unstable situation in the Chinese market. Now, The introduction of a 34% tax may further complicate the company's situation. A similar situation is developing in the field of electronics and high technology. While the United States holds a leading position in the production of semiconductors, software, and other high-tech goods, the Chinese market plays a vital role in shaping the global revenue of American companies. Establishing a 34% tariff barrier makes it difficult to both export products from the U.S. to China and operate supply chains that originate in China. If Beijing begins to impose additional restrictions on the activities of American companies in China, this could destabilize the industry on a global scale. The first signs of this trend already appeared on Wall Street between April 3rd and 4th. The second wave of decline in technology stock quotes reflected investors' growing concerns about the escalation of the crisis. So, what will the introduction of this 34% tariff cost the American economy? Many analysts estimate that the initial reduction in trade volume will be between $40 and $50 billion, considering that China currently purchases about $130 billion worth of American goods. A substantial list of goods is under threat, and if the soared 34% tariffs deter consumers from seeking other suppliers, the losses could become even more significant. We must not forget the potential domino effect. If the example of retaliation inspires other countries, and such major players as the European Union or Canada introduce mirror measures, the position of American business in the global arena will weaken. For Wall Street, this is fraught with increased volatility, pressure on corporate profits, and, as a consequence, a downward revision of growth forecasts. The well-being of ordinary Americans will also be hit. Consumers have already felt the increase in prices for goods dependent on imports by Independence Day. The Chinese response was not long in coming, putting American exporters in a difficult position. Farmers faced falling incomes. Automakers are revising plans. Technology giants are forced to reduce production volumes, and the prospects for employment and wages are becoming increasingly uncertain. The United States of America risks finding itself in the grip of an economic downturn, facing a reduction in export markets while simultaneously paying for imports at inflated prices, which will inevitably fuel inflation. Experts unanimously characterize such a scenario as a losing one, recalling that large-scale protectionist measures in history have often led to similar consequences. In the current situation, China's position looks very clear. Tough actions by the U.S. will be followed by a proportionate response. Chinese media emphasize that any sector in which the American side launches an offensive may face a retaliatory strike of the same force. This means that the conflict could go far beyond agriculture and automotive manufacturing. According to some reports, the government in Beijing is developing large-scale stimulus packages designed to cushion external shocks by strengthening domestic consumption. In response to American tariffs, China may resort to additional stimulus measures and reorientation of trade relations. CNBC reports that China, as one of the world's largest manufacturing centers, may accelerate the transfer of production to other regions, such as Europe, Southeast Asia, and Africa, making it clear that the Chinese market remains open, but trade with the U.S. involves unacceptable risks. The trade confrontation between the two largest economies in the world threatens to turn into isolation for the United States in a complex web of global supply and demand. Tensions between the U.S. and China are causing serious concern in other countries as well. European publications are full of headlines that the clash of the two giants will inevitably affect everyone. Asian stock markets are closely monitoring every step taken by Washington and Beijing. Countries such as Japan and South Korea are trying to determine their place in the new geoeconomic reality. At first glance, it may seem that what is happening is exclusively a problem for the U.S. and China. However, in the context of global economic integration, each country is, to one degree or another, a link in a single chain. The retaliatory measures taken by China are hitting international corporations with production facilities in the United States, which, in turn, creates a domino effect affecting suppliers in Europe. From agricultural products to advanced technologies, from energy trade to logistics, all participants in the global market are forced to look for new adaptation strategies. It is no coincidence that financial circles are increasingly talking about the possibility of a second bottom in the U.S. stock market, caused by news of these very retaliatory measures. The world is holding its breath in anxious anticipation, when just a couple of days ago the markets were shaken by a wave of panic that washed away $3.1 trillion. As if in a sinister déjà vu, Beijing's decision to impose 34% tariffs has once again plunged investors into a vortex of fear. Stocks are plummeting, and voices are increasingly calling for preparations for the worst-case scenario in the coming weeks. Technology giants such as Apple and Microsoft, as well as automotive giants like GM and Ford, are particularly hard hit. It seems we are only at the beginning of an unprecedented trade war, and if tensions persist for several months, the specter of recession will become very real. Analysts unanimously warn that protectionism will only exacerbate the losses of the global economy, and ultimately everyone will suffer. But what prompted China to take such drastic measures? Beijing has long expressed outrage at Washington's unilateral accusations. The PRC authorities insist that they are open to a diplomatic resolution of disputes concerning technology transfer, intellectual property rights violations, and the huge trade deficit. On April 2nd, the Trump administration, drawing a line under years of fruitless negotiations, signaled its readiness to erect a tariff wall between the United States and China. In response, China, instead of the expected slight increase in duties, demonstrated its determination and steadfastness, sending a clear signal to the world: we will not back down. This conflict not only jeopardizes the world's two largest economies, but also forces other countries to decide which side they are willing to take. Major players, such as the European Union, Canada, and Mexico, in an effort to protect their own interests, may follow suit and impose similar tariffs against the United States or China. Trade between the United States and China, reaching $660 billion a year, is not just an impressive figure. It is the backbone of global supply chains. Thousands of product names, hundreds of thousands of suppliers, and millions of workers around the world depend on this flow. Now, the erected barrier of 34% affects all levels, from stock exchanges with their trillion-dollar turnovers to farmers' fields, from giant corporations to small artisans. The question hangs in the air whether the unfolding trade confrontation will become the new reality, or whether the parties will still find a way to compromise at the negotiating table. This uncertainty, like a sword of Damocles, hangs over the markets, causing anxiety and unpredictability. Billion-dollar flows, changing their owners in one day, indicate that panic selling may become a long-term trend, covering more and more sectors of the economy. Such a tough line of behavior on the part of China is already having a destabilizing effect on the U.S. stock market for the second time. Experts note that American tariffs, which were introduced with fanfare, are naturally facing resistance, given the significant share of the United States in China's foreign trade. However, the emerging picture may make American society question the feasibility of such a policy. If prices continue to rise, inflation goes up, and job cuts become commonplace, it will be increasingly difficult for the White House to maintain its chosen course. Public opinion may become the force that will force a review of the current strategy. The Trump administration, like an experienced strategist, is addressing a clear signal to its electorate. American industry will be protected at any cost. Retreating in the face of a powerful populist wave is fraught with political losses, so the course remains unchanged. However, many experts warn that there will be no winners in this trade war. Both sides risk depleting their resources, as in a suicidal battle. The protectionist measures of the 1930s come to mind when customs barriers only exacerbated the Great Depression. Today, globalization has reached a much higher level, which means that the consequences of any economic collapse can be felt much wider and more acutely. In the event of an escalation of tensions between the United States and China, the world may face a reduction in trade, a decrease in economic growth forecasts, a wave of corporate bankruptcies, and rising unemployment. If other major players, such as Mexico, Canada, and European countries, introduce similar tariffs for self-defense, a total wave of protectionism could inflict an even more devastating blow on the global economy. American stocks have already reacted with a sharp fall to China's actions, but further developments remain uncertain. The world is waiting, wondering what other surprises this unpredictable trade war will bring. In the foreseeable future, one can hardly expect concessions from either side, which is fraught with a protracted confrontation, the consequences of which will be felt by the whole world. Businesses will inevitably face the need to restructure logistics chains, requiring significant time and financial resources. Consumers, in turn, will face rising prices, which will inevitably lead to a decrease in demand. The agricultural sector and industrial production will be under threat, increasing the risk of job losses. Financial markets, anticipating the upcoming changes, may once again experience a period of turbulence. Some analysts are already talking about the second day being over, but it is possible that we will face a third and fourth day as well. Prolonged uncertainty could fundamentally change the architecture of world trade. Turning to statistics, the key items of trade between China and the United States are electronics, textiles, machinery, automobiles, agricultural products, and chemical industry products. The United States exports soybeans, meat products, cars, and aircraft to China, while imports from China include semiconductors, consumer electronics, textiles, and components for mechanical engineering. The introduction of mutual tariffs between the two largest economies in the world inevitably leads to a redistribution of global trade flows. The new 34% tariff, the burden of which falls on both American and Chinese consumers, is becoming a serious test for both sides. The United States, seeking to protect the domestic market, is facing rising prices for imported goods, which directly affects the purchasing power of the population. China, in turn, is trying to support domestic producers by making American products less competitive, but this may force the country to look for alternative sources of supply. It is likely that if trade between the United States and China is reduced or terminated, other countries will see this as an opportunity to strengthen their position in the global market. They may take a wait-and-see approach, watching the giants fight, and gradually seize the vacant niches. The question of how painful China's response measures will be for the U.S. economy remains open. Declining profitability of American companies and rising consumer prices will be the first alarming signals indicating the negative consequences of the trade war. In the long term, a protracted confrontation between the United States and China could lead to serious changes in the global balance of power. World trade will inevitably reorient itself and show who will win in this struggle and who will suffer the greatest losses. Every day brings a kaleidoscope of events, from reports of retaliation to sudden collapses on stock exchanges and glimmers of hope for a diplomatic settlement. Trade battles are flaring up with renewed vigor, as if testing the strength of the world economy. The outcome of this test could have far-reaching consequences for the entire global system, not just